Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to turn to Simon Rose of SaveOurSavers.com. No, .co.uk. That's right. All right. Simon Rose, welcome back to the Kaiser Report.
Thank you, Max. It's always good to be here.
I saw you on Newsnight.
Yes, I was on Newsnight. A discussion about savings on the BBC's flagship discussion programme. Quite extraordinary.
Now, I was struck by one of the guests, Frances Coppola, who made an extraordinary statement. She said, putting money in the bank is not a good use for a bank.
Yes. Well, of course, if all savers did what the Bank of England wanted and take their money out of the bank, what would happen then to interest rates? I wonder. They would shoot skywards.
Simon Rose, capitalism is based on capital. That
Indeed.
Capital comes from the earnings of workers who put their savings into banks.
It is, yes.
That's where capital for capitalism comes from.
That's where it should come from.
This woman, Frances Coppola, is saying, don't put your money in the bank. So therefore, all money for consumption, all money for investment, and all money for corporate expenditures is essentially borrowed from the Bank of England. That's why the Bank of England has the largest balance sheet in its history. It's over £3 trillion. That's why the UK economy is at the biggest debt load in its history.
You know that, and I know that.
It's approaching £2 trillion. At this rate, the UK will have £4 trillion in debt. Because this woman, Frances Coppola, says that you shouldn't put money in the bank. That's the last place you should put money in the bank.
Yeah, but she's in tune with almost everybody else. We've got a new central banker here, Mark Carney, and we might have expected he'd have a different view to everybody else, but no, the idea is, we can't get the recovery in any other way, so let's just keep borrowing beyond our means in order to push the economy ahead. And it's crazy. Let's not use real savings.
Let's play the clip of this woman, Frances Coppola, in a remarkable statement.
I don't think myself that buy-to-let is a particularly good strategy for an investor who's iffy about risk, simply because we shouldn't forget, for example, in the crash in 2008, Bradford and Bingley actually failed because the bottom fell out of the buy-to-let market. It happened before and it can happen again. And I think this looks a little bit like an overheating bubble to me. So it needs some care, but people should not be expecting just to put large amounts of money in a bank account and leave it there by way of long-term savings. That's not a good use of bank accounts.
So I wasn't making that up. She thinks, I don't know where she thinks money comes from.
But they all don't seem to understand. I mean, when he was in opposition, Osborne understood that you needed a strong savings sector because savings actually provide the investment that will enable us to become wealthier and to grow the economy. But once you're in government, that's just inconvenient. You're the biggest debtor of all. They're still borrowing £120 billion every year. We've got a national debt of something like £1.3 trillion. Well, he's not going to say that anymore. You think back to 1976 when everybody was ashamed in this country because the IMF bailed us out. You remember how much that bailout was? £2.3 billion. That's a 50th of our annual deficit, and it's 1/500th of our national debt. It's chicken feed.
Let's talk about that scoundrel, Mark Carney. He's got a new theory about inflation and GDP, and he really worked a little hockey puck brain overtime on this one. Tell us about it.
It seemed revolutionary when he was actually saying it until you actually look at what it is. Basically, they're saying we're not going to really think about even discussing whether we'd raise interest rates until unemployment rate gets down below 7%. It's currently 7.8% in this country. But there are a few caveats, of course. If, for instance, there would be some sort of financial crisis, well, we'd rethink it, thank goodness. If inflation shoots ahead, well, we'd rethink it. And if on the 18 to 24-month projection, we think inflation will be above 2.5%, well, then we'll rethink it. The thing is, the Bank of England's forecasts are always wrong. They always overestimate growth. They always underestimate inflation, often by as much as sort of 1 percentage point. So if they think inflation, surprise, surprise, in their forecasts, 18 to 24 months, well, it's going to be about 2.5%. So if they think it's 2.5%, the chances are it's probably going to be 3.5%. That's CPI inflation. On RPI, which is what most people look at because it includes most living costs, when you talk about inflation getting on towards 5%. And our new governor is happy with that. Not only that, but our chancellor seems to be happy with that. Now, as Carney said, the primary remit of the Monetary Policy Committee of the Bank of England is maintaining price stability, and only subject to that to supporting the economic policy of the government for growth and employment. And the last remit said the inflation target should be 2%, and this applies at all times. And yet somehow the Chancellor has sent a letter to Carney saying, yeah, I like your new policy, it's fine. You've chosen 2.5% instead of 2%? Well, that's fine, I don't really mind. What is going on here? They clearly do not mind if inflation goes up. They think somehow a bit of inflation is somehow good for growth. But most people are now suffering really, really severely from the rise in prices being so much higher than wages.
But wait a minute, it's not really growth they're talking about here. They want a rise in GDP so that the debt looks smaller by comparison.
Yeah.
Because the debt, as a percentage of GDP in the UK, is what, 90% of GDP, something along those lines?
It depends how you measure it.
Depends on how you measure it.
Yeah.
Now, when it gets to a certain 90% or 100%, of course, alarm bells ring. So that instead, they're going to print a lot of money. They're going to stoke a real estate bubble. They're going to pump up GDP based on speculation and borrowing. So they're borrowing record amounts of money to create a GDP number that they'll say is greater as a percentage of the debt. So it's not about growth. It's not about nominal growth. It's about relative growth to debt. Of course, most of the debt is not even accounted in the official government statistics. It's held off balance sheet, like an Enron, for example. So there you have problem number one. Problem number two is that you can create a lot of jobs, but wages on average are going down.
Yeah.
So you got temporary workers, part-time workers, workers who are not making, the wages are increased at less than 1%.
Yeah. Very similar to the picture in the United States. It's extraordinary how similar the picture is. No, here, if you look over the last 5 years, wages have gone up in nominal terms by about 10%. But if you look not at the RPI or the CPI, but the essentials index that Dr. Tim Morgan is doing, which is the 8 things that people have to spend money on, because it affects the people who are poor.
8 things?
8 essential things: food, food, energy, transport, that sort of thing.
Is that the same as CPI?
Oh, no.
Is it the same as RPI?
CPI is the one the government wants to use. It's not the same as CPI. Over the 5 years from 2007 to 2012.
Is that statistical sophistry?
No, this is actually trying to make an index that reflects what people actually experience, not what the government feels they should experience.
You have the real index.
The Tim Morgan Essentials Index, which is the one that we like.
Who's Tim Morgan?
Tim Morgan was chief economist at Tullett Prebon, the firm you mocked. He's now set up on his own. He's a wonderful economist, but he says that over 5 years, from 2007 to 2012, when wages went up by 10%, the prices of the essentials went up by 33%. So the people are really getting squeezed, especially at the low end. Not most of the people in the city, they earn enough not to really notice how much food costs. But we had retail prices out this week, and the inflation didn't look as if it was terribly severe. But in fact, if you look at food prices, they're rising at double the level of pay. So you had, for instance, potatoes up 13% on the year, sausages 11%, apples are up 36% on the year. These are things people have to buy, unless somehow George Osborne thinks people don't need to eat.
Plus substitution, you've had the scandal of replacing horse meat for beef, that was part of it. I see, for example, honey has been now being sold without pollen. So now, if you want to have the same reconstituted honey, you have to buy the pollen separate, which the price of the reconstituted honey would be double or triple.
You talk about sophistry, but we are living in a world of sophistry. It's sort of Alice in Wonderland world.
You use the word sophistry correctly. You're saying I use it incorrectly.
No, I'm saying I'm agreeing with you.
That's because you're British? You think you have some mastery of the English language? I mean, American is the proper way to say stuff.
No, I certainly don't. But when you look at Carney's presentation, everybody fell for it almost immediately. Somehow there's this weird cult that Carney can do something magical. I mean, there was all this, he doesn't go off and watch cricket, he goes off to pop festivals with his family. He was lauded for taking the tube to work on the first day, not using his chauffeur-driven car. I'm surprised he didn't walk to work on the waters of the Thames.
Right, but let's repeat some of the salient points here. The fact is that forward guidance on interest rates, as he's talking about, creates malinvestment. It penalizes savers. Roughly 200 billion pounds of savings has been stolen and given to speculators.
More. Our latest figures are, in the time since March 2009, when base rate went down to 0.5%, we reckon that the loss of interest and the effects of inflation have cost Britain savers 285 billion. If Carney's right, and we've got another 3 years of this, if unemployment doesn't go down below 7% until 2016, near the end, then we're talking about a total amount stolen of getting on for 500 billion, 492 billion pounds. Okay, it's an extraordinary transfer of wealth.
The average person in the UK says, okay, I'm willing to accept the fact that my savings accounts are being stolen and my neighbors' savings accounts are being stolen because I'm paying less on my mortgage, because the tracker rate, and for years now the rates have come down.
Some people don't track a mortgage, yes.
However, now, since Mark Carney arrived in London, that interest rate on the 10-year note is going higher.
Oh, yes.
We've entered a secular market. So here you have a situation where 2 or 3 years' time, there's a real estate crash, as I'm predicting, people are back into negative equity, and they've had their savings stolen. So it's the worst of all possible worlds.
Yeah.
You don't have the equity in your house, and you've had your savings stolen by some, you know, Mark Carney, madman wannabe poser from Canada who left that economy in a shambles.
Yeah, they've got real housing problems in Canada now. Yes,
it's completely
he got out
crashing.
at just the right. You can't fault him for timing. He left Canada at just the right time.
He's a scrounger.
Yeah.
He's a global scrounger.
But you're right.
He's flown around the world, and he's just scrounging from the suckers. Now he's in the UK, saying, give me triple, quadruple my house. His wife can't find a house, you know, for what, £20,000 a month or something? Oh, there's nothing to find in London. I can't find my...
And they gave them an extra £250,000 a year living expenses, because London is just...
For that scrounger, Mark Carney?
£870,000 a year.
So then George Osborne, of course, is working with him now, because he'll say, well, actually, George Osborne's going to be running the show, isn't he? Because he's going to have his finger on the valves of the employment numbers, bing, 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 and then they're going to adjust the interest rates based on this employment number that Osborne's going to be cooking up over
Yes,
the Treasury.
you could argue, of course, I mean, Osborne is the biggest debtor of all because of the government debt of $1.3 trillion.
Right.
So if unemployment actually goes below 7% and Carney's thinking about raising interest rates, that's actually a disincentive for Osborne to want to reduce unemployment.
Exactly.
But all he wants is house prices to go up before the next election. We've got an election looming only 1.5 years away. As long as everybody feels good because of rising house prices, that Osborne's calculation is he'll get back in.
It's a Tom and Judy show. These guys are playing Punch and Judy show, where Osborne says this, Carney says something else, they cancel each other out. As you said, he's disincentivized to get that number down because it would then trigger all kinds of economic mayhem. So that doesn't add up either.
You were saying interest rates on a variable mortgage have gone down, but if you're actually borrowing on an overdraft from your bank, if you're actually borrowing on a credit card, the rates are still virtually the same as they were before the crisis started. The only real benefits being to, you know, large borrowers like the government and companies that are effectively zombified, that really should have gone out of business, been kept alive, depriving other companies of the money, and the people on variable rate mortgages. And that's been at the expense of almost everybody. It isn't just savers and pensioners who are being hit now. Everybody now is appreciating that our money is depreciating all the time, and they understand they are getting poorer. And who's to blame?
Even the conservatives over there at the Telegraph and City AM are saying Carney and Osborne have stoked a housing bubble.
Yeah. And all bubbles eventually burst.
And you'll be left with negative equity, but all the debt.
Yeah, well, there's still many areas of the country there still is negative equity.
And where will Carney be then? Let's figure that out. What country will he go to next? He went Canada, destroyed Canada. He come to the UK. He's just a fly-by-night scrounger. Carney, it means carnival man or con artist.
Yeah, yeah.
You know, it's right there in his name. He can't say that. Oh, I didn't tell you I was a showman, a Carney man. All right. Well, we'll have to come back and discuss this again. All right, Simon Rose from SaveOurSavers.co.uk. Thanks once again for being on the Kaiser Report.
Thank you, Max.
And that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, Simon Rose of SaveOurSavers.co.uk. If you'd like to get in touch, tweet us at Kaiser Report. Until next time, Max Kaiser saying bye, y'all.